Imagine waking up one morning and realizing the dollar in your wallet doesn't buy what it used to, not just because of inflation, but because money itself has changed. Money moving at the speed of the internet, governments competing with technology companies, digital currencies replacing systems that took centuries to build. The global money system you grew up with is ending and a new one is already being built. Today, I want to walk you through where global money came from, why the current system is under pressure, and most importantly, where it's heading next. This isn't hype. This isn't conspiracy. This is economics, technology, and power colliding in real time. The modern money system is built on fiat currency, money backed not by gold, but by government authority. In 1971, the US officially abandoned the gold standard. From that moment on, money became, as this transformation continues, one of the most important dynamics to understand is how power shifts when money changes form, because throughout history, whoever controls money ultimately influences trade, politics, and social stability, and in the coming decades that control will no longer sit exclusively with central banks or traditional financial institutions, but will be shared, contested, and in some cases challenged by technology platforms, decentralized networks, and even communities themselves, which means individuals will increasingly face choices that previous generations never had to consider, such as whether to store value in a government-issued digital currency, a private stablecoin, a decentralized asset, or a mix of all three, and each choice will come with trade-offs between convenience, security, privacy, and sovereignty. At the same time, automation will quietly reshape how money moves behind the scenes, with smart contracts executing payments without human approval, salaries being distributed in real time instead of bi-weekly, insurance claims settling instantly based on data inputs, and global supply chains using tokenized money that releases funds the moment goods arrive, reducing friction but also reducing human discretion, which raises a deeper question about accountability when algorithms, rather than people, make financial decisions. Another major shift will be how savings and investing evolve, because traditional savings accounts already struggle to beat inflation, pushing households toward assets and markets they may not fully understand, while tokenization will make it possible to own fractional pieces of real estate, infrastructure, art, and even government bonds, opening opportunities but also increasing exposure to market volatility. And as access expands, the gap between those who understand financial systems and those who don't may widen rather than shrink. Global labor markets will also be affected, as digital money makes it easier for companies to pay workers anywhere in the world instantly, intensifying competition for jobs while also creating opportunities for skilled individuals to earn across borders without relying on local banking systems, which could weaken national control over wages and employment while empowering individuals who can adapt. Meanwhile, governments will face a delicate balancing act because they must modernize their monetary systems to remain competitive while preserving trust. And history shows that once trust in money is lost, it is incredibly difficult to restore. So policy mistakes in the digital era may spread faster and have more immediate consequences than in the past, especially when capital can move globally in seconds rather than days. Inflation itself may change character, becoming more visible and more political as digital systems allow real-time tracking of prices, wages, and consumption, potentially increasing public pressure on policymakers and reducing their ability to quietly manage economic pain, while at the same time making economic data more transparent than ever before. Another underappreciated factor is demographics, because younger generations who grew up with smartphones, apps, and online identities are far more comfortable with digital money than older generations, and as they gain economic influence, demand for faster, more flexible, and more global financial tools will accelerate, forcing institutions to adapt or lose relevance. Trust, which has always been the foundation of money, will increasingly be distributed rather than centralized, with people trusting code, networks, and communities alongside or even instead of governments. And this shift does not mean the end of states or central banks, but it does mean they must compete for legitimacy in ways they never had to before. Geopolitical competition will also play out through monetary innovation, as nations race to build systems that attract capital, talent, and trade, using digital currencies and payment networks as tools of influence, which could reduce the effectiveness of traditional sanctions while creating new forms of financial pressure. For individuals, the psychological relationship with money may change as well, because when money becomes numbers on a screen governed by rules you cannot see, fear and uncertainty can increase, making financial education not just a technical skill, but a form of emotional resilience. The future will likely reward those who remain flexible rather than loyal to any single system, those who understand that no form of money is permanent, and those who prepare for change rather than reacting to it. Because while technology will reshape the mechanics of money, human behavior will continue to drive booms, busts, speculation, and fear, meaning cycles will not disappear, only accelerate. And perhaps the most important realization is that the future of global money is not being decided in one place or by one authority, but through millions of daily decisions made by consumers, investors, businesses, and governments around the world, each choosing what they trust, what they use, and what they value. And in that sense, the future of money is already here, unfolding quietly in payment apps, digital wallets, online markets, and policy debates, shaping a system that will define economic life for decades to come. As this evolution deepens, another layer that deserves attention is how financial inequality may be reshaped rather than erased, because while digital money promises inclusion, it also rewards speed, knowledge, and access, meaning those who understand systems early can move capital faster, arbitrage opportunities globally, and protect themselves from policy shocks, while those who remain dependent on a single paycheck, a single currency, or a single institution may feel increasingly exposed, and this is why education, not regulation alone, becomes the real equalizer in the future of money. We are also likely to see money become more customized to context, with different forms of currency optimized for different purposes, such as highly traceable digital money for public spending, privacy-focused instruments for personal savings, and programmable tokens for business and trade, breaking the illusion that one form of money must serve every function equally well. The banking system itself will continue to change from a place where money is stored to a service layer that manages identity, compliance, risk, and access, because custody and transfers can increasingly happen outside traditional banks, forcing them to compete on trust, experience, and integration rather than exclusivity. Credit, too, will evolve. As alternative data and real-time cash flow analysis replace traditional credit scores, allowing lenders to assess risk dynamically, but also raising concerns about constant financial surveillance, where every transaction becomes part of a profile that determines opportunity. At the global level, emerging markets may leapfrog legacy systems entirely, adopting digital money faster than developed economies, not out of preference but necessity, and in doing so, they may shape standards and innovations that later flow back into advanced economies, reversing the traditional direction of financial influence. Trade and settlement systems will likely fragment into overlapping networks, some aligned with political blocs, others driven purely by efficiency, and businesses will have to navigate this complexity by holding multiple forms of liquidity, hedging not just against currency risk but against system risk, where access itself can be restricted. Cultural attitudes toward saving and spending may also shift, as real-time feedback on finances makes people more aware of their behavior, potentially encouraging better habits for some while increasing anxiety for others. Especially in a world where economic shocks can ripple instantly through digital systems, the role of physical assets may change as well, because when money feels abstract and intangible, tangible assets like land, commodities, and infrastructure often regain psychological appeal as anchors of value, even as they become digitally represented and traded through tokens. Taxation and government revenue collection will become more automated and immediate, reducing evasion but also limiting flexibility for individuals and businesses, which may push more economic activity into informal or alternative systems if trust is not maintained. Another critical dimension is resilience. Because digital systems are efficient but vulnerable to cyber risks, technical failures, and systemic bugs, making redundancy and diversity in monetary systems not just desirable but essential for stability. And this may be one reason cash, despite predictions of its death, continues to persist as a backup rather than a primary tool. Environmental considerations will increasingly influence monetary design as well, with pressure to reduce the energy footprint of financial systems, pushing innovation toward more efficient consensus mechanisms, greener infrastructure, and policy incentives tied to sustainability metrics. Narratives around money will also evolve as societies debate what money should represent in an age of automation and artificial intelligence, especially when productivity gains no longer translate cleanly into wages, forcing questions about universal basic income, digital dividends, and new forms of redistribution that would have been politically unthinkable in earlier eras. At the individual level, identity and money will become more closely linked through digital credentials, simplifying access but increasing the consequences of exclusion, errors, or misuse, making governance and oversight as important as technological capability. Markets themselves may become more reflexive and faster moving, as algorithms react not just to prices but to policy signals embedded directly in monetary code, amplifying trends and potentially increasing volatility during periods of uncertainty. Trust in institutions will be tested repeatedly as transitions create winners and losers, and the institutions that communicate clearly, adapt quickly, and respect user choice will likely retain legitimacy. While those that rely solely on authority may struggle, education systems may gradually integrate financial and digital literacy as core skills rather than electives, recognizing that understanding money is no longer optional in a world where financial decisions are embedded in everyday technology. For families, conversations about money may start earlier and become more complex, involving not just budgeting and saving but choices about platforms' custody, privacy, and long-term exposure to different systems. International cooperation will face new challenges as money becomes software, requiring agreements not just on exchange rates and reserves but on code standards, data sharing, and cyber defense. And throughout all of this, human behavior will remain the constant variable, with fear, greed, optimism, and skepticism shaping adoption curves and market cycles just as they always have, reminding us that while the tools of money may change dramatically, the underlying dynamics of trust, incentive, and belief continue to define its role in society, pushing the global monetary system forward through experimentation, adaptation, and occasional crisis rather than through any single, neatly planned transition. As the pace of change accelerates, the psychology of trust will become one of the most decisive forces shaping how people choose to store, spend, and invest their money, because in a world where multiple monetary systems coexist, trust will no longer be assumed but constantly evaluated, renegotiated, and sometimes withdrawn, and this means reputation, Transparency and reliability will matter as much as interest rates or returns, especially when users can switch platforms or currencies with a few taps on a screen. This environment will likely reward systems that are boring, predictable, and resilient over long periods rather than those that promise dramatic gains. Yet history suggests that during times of transition, speculation tends to increase before stability returns, as people test boundaries, chase opportunity, and learn through both success and failure. Another subtle but powerful shift will involve time itself, because when money moves instantly and markets react continuously, the distinction between short-term and long-term thinking can blur, encouraging impulsive decisions unless individuals consciously slow themselves down, which may lead to a renewed appreciation for frameworks, rules, and automation that protect people from their own biases. Corporations, too, will rethink how they manage capital, treasury operations, and risk, holding diversified digital reserves, settling transactions across multiple networks, and embedding financial logic directly into their operations, which could increase efficiency, but also create dependencies on technical infrastructure that must be carefully managed. Insurance markets may evolve to cover new forms of financial risk, such as smart contract failures, digital custody breaches, or systemic network outages, turning previously uninsurable uncertainties into priced risks. While also reinforcing the interconnectedness of financial actors, the relationship between money and data will deepen, as transaction information becomes a valuable resource for forecasting economic activity, consumer behavior, and systemic stress, giving those who control and analyze data a strategic advantage and raising ethical questions about ownership, consent, and fairness. Monetary policy itself may become more experimental, with central banks using targeted tools to influence specific sectors or behaviors rather than relying solely on broad interest rate adjustments, a shift that could increase effectiveness but also political scrutiny. Especially if outcomes appear uneven across different groups, local and community-based financial systems may experience a revival, enabled by digital tools that make it easier to create and manage localized currencies. Credit networks or cooperative platforms offering resilience and alignment with local values while still connecting to the global economy. Remittances and cross-border family support will continue to improve as digital money reduces fees and delays, quietly redistributing billions of dollars more efficiently and strengthening economic ties that traditional systems often neglected. Meanwhile, the legal and regulatory landscape will remain in flux as lawmakers attempt to balance innovation with protection, often reacting to crises rather than anticipating them, which means periods of uncertainty will persist and adaptability will remain a competitive advantage. Education and storytelling will play a crucial role in shaping adoption, because people do not adopt systems they do not understand, and narratives about safety, empowerment, and progress will influence behavior as much as technical features. Generational divides may temporarily widen as younger users embrace new forms of money faster than older ones, but over time, usability improvements and necessity will narrow those gaps, just as they did with the internet and smartphones. The workplace will continue to integrate financial tools directly into productivity platforms, blurring the line between earning, saving, and investing, and making money management a more continuous rather than episodic activity. Ethical debates around inclusion will intensify as societies confront the reality that access to digital money requires access to technology, identity verification, and connectivity, all of which are unevenly distributed, forcing policymakers and institutions to address gaps or risk entrenching disadvantage. Global crises, whether financial, environmental, or geopolitical, will act as stress tests for emerging systems, accelerating adoption where they perform well and undermining confidence where they fail, reinforcing the idea that robustness matters more than elegance. The symbolism of money may also evolve, as physical currency once carried national imagery and cultural meaning, while digital money may express values through design choices, governance models, and usage norms, subtly shaping how people relate to it. Innovation will not be linear, and setbacks, reversals, and hybrid models will be part of the process, reminding observers that transitions of this scale rarely follow clean timelines. Individuals who cultivate optionality, maintaining access to multiple systems and staying informed without becoming reactive, will be better positioned to navigate uncertainty, while those who cling rigidly to a single model may experience greater disruption. Discussions about fairness and redistribution will gain urgency as productivity gains from automation and digital finance challenge traditional labor-based income models, pushing societies to rethink how value is created and shared. Financial storytelling on platforms like YouTube, podcasts, and social media will continue to shape public understanding, sometimes clarifying complex issues and sometimes oversimplifying them, making critical thinking an essential skill for audiences navigating conflicting claims. International institutions may struggle to coordinate responses at the speed of technological change, leading to a patchwork of standards and alliances that evolve through practice rather than agreement. Personal financial planning will increasingly incorporate scenario thinking, preparing not for a single expected future, but for multiple plausible ones, each with different assumptions about inflation, growth, regulation, and technological adoption. Throughout this period, moments of calm and confidence will alternate with moments of anxiety and doubt, as markets and societies adjust to new norms. and the ability to remain grounded, informed, and flexible will distinguish those who merely endure change from those who use it as a catalyst for greater stability and opportunity. As the global monetary system continues to transform through countless interconnected decisions, experiments, and adaptations unfolding simultaneously across economies, cultures, and technologies, the future of global money is not a distant concept waiting to arrive someday. It is already shaping how value moves, how power is distributed, and how opportunity is created across the world. And while no one can predict every detail of what comes next, one truth is clear: money is becoming faster, more digital, more competitive, and more deeply connected to technology than at any point in human history, which means the systems that once felt permanent are now negotiable, and the assumptions that once felt safe must be re-examined in this new era. Those who succeed will not be the ones who cling to the past or blindly chase every new trend, but those who understand how money works, recognize where trust is shifting, and remain flexible enough to adapt as the rules evolve. Because financial security in the future will come less from loyalty to a single institution and more from knowledge, optionality, and informed choice, this transition will create uncertainty, but it will also create opportunity. And history shows that moments of monetary change, while uncomfortable, have always rewarded people who prepared early rather than reacted late. The real divide in the coming years will not be between digital and traditional money, or between governments and technology, but between those who take responsibility for understanding the system they operate in, and those who leave their financial future to forces they do not understand. And that is why learning about money is no longer just about wealth. It is about independence, resilience, and control. If you want to be on the right side of this transformation, stay informed, question assumptions, diversify your exposure, and invest in your financial education. Because the future of global money will not wait for permission, and those who understand it will shape their own outcomes rather than be shaped by it.